Imagine you're about to go on a road trip in a new city, but before you start driving, someone slaps a huge sticker on your car saying 25 surcharge with no explanation. That wouldn't feel right, would it? The same thing happens with traders, but instead of a sticker, it's a bunch of hidden costs stacked onto their winning trades. Let's break down these hidden costs and remove the sticker, so you can get where you're going with your trading. So, what are these hidden costs? When you trade, you're not just buying and selling assets, you're also dealing with taxes and fees. When you buy assets like stocks, bonds, or commodities, you're typically buying them from a brokerage firm that facilitates the transaction. That firm takes a small percentage of your trade as a fee for their services, and this is called a trading commission. Think of it like sending a letter, you pay for the stamp, and in trading, the commission is your trading stamp. Let's look at a simple example to see how this works. Imagine you buy 100 shares of Apple stock for 100 each, costing you 10,000. Now, let's say your brokerage firm charges you a 2 commission for the trade, which is 200. So, your total cost for buying those shares is 10,200. As you can see, that commission might not seem like a lot, but it can add up over time, especially if you're trading frequently. Many beginners make a common mistake by not accounting for commissions or fees in their trading strategy. They think they are making money, but they are actually losing a lot due to these hidden charges. To avoid this, you need to understand the fees associated with your brokerage firm and adjust your trading strategy accordingly. Let's talk about capital gains taxes. When you sell assets, you might have to pay capital gains taxes, which depend on how long you held onto those assets. Think of it like holding onto a valuable item. If you held onto it for a while, it'll decrease in value over time, making it easier to sell it without owing taxes on any gains. But if you sell it quickly, you might have to pay more taxes on the profit you made. The key to understanding capital gains taxes is to know the holding period. If you held onto the asset for a year or less, the profit is considered short-term and is subject to your regular income tax rate. But if you held onto it for more than a year, the profit is considered long-term and is subject to a lower tax rate, which can be as low as 15% for investors in the top tax bracket. Slippage is another hidden cost that many beginners ignore. When you place a limit or stop-loss order, there's a chance that it might get executed at a worse price than expected, and this is called slippage. Imagine trying to buy your favorite snack at the price you want, but someone else buys it first, and you have to pay a higher price. Slippage works the same way. So, how can you avoid losing money to these hidden costs? First, you need to understand the fees associated with your brokerage firm, including the trading commission, and adjust your trading strategy accordingly. You might also consider using a commission-free brokerage firm or exploring other low-cost options. For your practical exercise, grab a piece of paper or open a demo chart and simulate a trading scenario. Let's say you buy 100 shares of Amazon stock at 100 each, and your brokerage firm charges a 1 commission. Assume you made a profit of 5,000 on the trade. On your paper or demo chart, calculate the total cost of the trade, including the commission. Now, subtract the profit, and you'll see how much you've actually lost due to the commission. Next, imagine you sold the shares and had to pay capital gains taxes on 20 of the profit. Calculate the tax and subtract it as well. Finally, imagine you had to pay slippage of 10 cents per share on the purchase, because the trade executed at a worse price than expected. This is a common issue in the stock market, and it's essential to account for it in your trading strategy. Calculate the slippage cost and subtract it from your total losses. Write down the total amount you actually lost on the trade, and you'll have a much clearer picture of how these hidden costs can eat into your profits. In conclusion, taxes, fees, and hidden costs are essential factors to consider in trading. By understanding these costs and being aware of your trading commission, capital gains taxes, and slippage, you can make more informed decisions and avoid the mistakes many beginners make. Remember, trading can be unpredictable, and there are no guaranteed profits. Practice on a demo chart or paper trading journal before risking your capital, and always keep a record of your trades. If you're looking to further develop your trading skills, be sure to subscribe to